Hello, my name is John Faulkner, and I am the host of the Smarter Systems Better Care podcast. And I'm here today with Kenny Spitler. Kenny is with the Woulton Group, and he's a renowned business development specialist and master negotiator with over 30 years of leadership navigating the healthcare and business sectors. Thanks to you for joining us today, Kenny.
Oh, you're welcome, John. It's my pleasure.
Thank you. And then just to get us started off, could you just tell us a bit about your background, your business model, and the clients that you serve at the Woulton?
Yeah, sure, John. Well, I've 40 years in the healthcare industry. Last 20 years have been dedicated to facility development, primarily in the ambulatory surgery center and surgical hospital arena. Our company, the Woulton Group, is a ambulatory surgery center and specialty surgical development, management, and consulting firm. We what makes us different in the management world is that we have a very unique model that is performance-based. So the typical model in the ambulatory surgery center space and the surgical hospital space is one which requires physician owners to allow an equity participation or buy-in by the groups. We do not require an equity position because we're not really in the game of buying cash flow. Yep. The typical model, when you buy cash flow, whether somebody performs or not, you're kind of stuck with them because they're equity partners. And the only way to be able to end those relationships is really to buy them out. And so an example I like to use often is if there's a facility that has about $500,000 worth of EBITDA, and let's just assume there's 10 physician partners and they have all equal ownership. Then typically you would come in and you would offer to buy, say, 30% of their ambulatory surgery center. And if you look at $500,000, which your typical minority multiple would probably be about a 4, and that turns into about a $600,000 investment for $300,000. That sounds really great on the front end because the doctors would all get $60,000 in their pocket. And then the companies, of course, would make the promises that they're going to be able to increase your revenue, be able to make sure your profitability is higher, be able to offer more efficiencies, maybe better pricing on supplies and equipment, better contracts with the payers, and so forth and so on. And there's oftentimes that doesn't work out. So you may have a situation where you have an evergreen contract that's tied to ownership, or maybe one's negotiated down to 10 years. And that is a long-term relationship, needless to say. And after about, 4 years or so of maintaining the same EBITDA, the doctors realize that if they were to perform, that would have been a really good deal for them. But if they don't perform, it really wasn't a good deal for them. They would actually end up allowing 30% of their distributions to go out to the partner companies over that period of time, and they would have been better off not having that $150,000 a year to be leaving their distributions. And after about 4 years, it would be break even for them. And so the management companies, of course, if the doctors get upset and say, hey, what have you done for us lately? You didn't do the things you said you could do. You didn't increase our revenue. You didn't increase our bottom line, our profitability, our EBITDA is the same, then we're not really happy. So the companies would then say, okay, well, we don't want you to be, upset at us, and we don't want a bad reputation for not performing. So we're happy for you to buy us out. So they would earn, $150,000 of distributions over four years. They would earn $600,000 plus their management fees, and then they would have to be bought out for $600,000. So they really had a no risk venture. And then the doctors are left scratching their head, going, "My goodness, what did I do?" And so our model is more based off of, management fees or something that are pretty standard in industries. There's a fair market range, and everybody pays the same, fair market range. We would still be in that range like everyone else. The difference is we will enter into a profit participation agreement that allows us to participate on profit that we actually are able to perform. So in the same scenario, at $500,000 in EBITDA, if we're able to come in and do the job that we think we can do and turn that $500,000 into $1 million in EBITDA, then we would share in the $500,000. That's the delta between what was already there and what has grown. And so it really aligns incentives with the surgical partners that we gain if they gain. If we don't gain, they don't gain, but they at least stay where they were. Okay. So they're not going to lose. So that $500,000 in distribution would still be something that they would distribute. And then if our performance was something that they weren't satisfied with, and they could, we could cancel the agreement and they would not have to buy us out. It would be much easier for them. So we try to align the incentives with the doctors. And of course, we never take equity. So our fees would come out as a expense in the P&L, and their distributable cash would be all theirs. So in the example I just gave, that $500,000, if we grew it to $1 million, they would actually end up distributing $900,000. So they would have a gain of $400,000 in distributions, where the scenario that I described that other companies do, they would not be able to receive those same value. Even if that company did grow their business to $1 million, they would be getting 30% of that $1 million. So they'd be getting $300,000, where the doctors only be getting $700,000. So our model, even if things were all equal, is going to generate a couple $100,000 more of distributable cash for a group of surgeons.
Yeah, it's a good, unique model too for them, because it shows that you have your skin in the game too with their performance, like their success, and that you're a partner with them, right? So that's a really attractive model, I'm sure, when you're working with your clients.
Absolutely. And then on the other side of our model that's a little bit different is that most of the companies that do management, they require, if there was a brand new project that needed to be developed, they'll develop it as long as they can manage it and they have ownership in it. We're happy to develop a project and not manage it. We can develop it and just charge them for developing it and not manage it. Certainly, we would be happy to develop it and manage it, but that is not a requirement. And then thirdly, anything that we do in our management services, we're willing to do on a consulting basis, and not, it doesn't have to be the whole enchilada. They can just, get the cheese and the onions on the side, so to speak. Yeah. It's just an opportunity. If they want, hey, we need help with compliance. Okay, we can consult with you on compliance. We need mock surveys. We can help them with mock surveys. If they, whatever the particular individual scenario would be, we can consult in those particular areas. And we have full service, initial concept all the way through exit. And what I like to say, it's basically soup to nuts in the ambulatory surgery center and surgery and the surgical hospital arena.
Well, thank you for kind of walking us through your model and how you can provide a lot of value to your clients and potential clients out there. And so what's like a major shift in this business development space that you're seeing for these ambulatory surgical centers? Because I've heard this before from other people that may not be in a business development role, but maybe they're actually like the owners of those surgery centers. What do you think people are underestimating in this industry that they may want to know about?
Well, I think probably the biggest shift that's occurred in the industry in the last, I'd say at least the last decade, has been a major presence of private equity firms that have been purchasing these companies, the management companies. And the private equity world is one that's based off of a time frame. Of course, they invest in their funds. They'll have 5 to 7 years, let's say. And within that period of time, their really biggest concern is the bottom line, period. It's about return on investment. And so when you get to the maturity date of the fund, then they're going to liquidate the assets, the good ones, the bad ones, and otherwise. And so what they're hoping to do is have spread enough risk that they're going to be able to provide the returns that their investors were looking for, what they promised their investors. And then there's going to be an exit. And so that exit sometimes could be really bad for the partners, and sometimes it can be good for the partners, but you really don't know until you get to that end game. Yeah. And so therefore, it's really not a long-term strategy to walk with your partners for a long period of time. We would really, so that's been a big shift in the marketplace. In addition, because of the private equity involvement, the box, so to speak, that you have has become more narrow, where We only want to do deals that have an X amount of EBITDA. We only want to be in certain markets. We only want to have things that we can see can have a tremendous amount of growth, or we only want to do projects that we see we can partner with certain hospital systems and so forth and so on. It has limited the it has limited the ability to some of these companies to be more nimble. And so a company like ours, we can be extremely nimble, and we're in it for the long term. We're not necessarily in every project to be able to take it to an exit. If we manage a facility and we manage it for 10 years or 20 years or 30 years, well, as long as we have a good relationship there and things are going well, then why would we not continue to do that? It's not about exit, and it's certainly not under a time frame where we have to get something done within a 5 or 7 year term based on the fund. Our company is self-funded. We don't have any investors. We do not have any private equity involvement, and we don't care to have any. And also, we are not building this company to sell it. We're building this company for legacy. And we even have a young partner that's 23. And, I have a daughter that's 27, and she's not in the healthcare space, but one day maybe I can convince her to be so. So we're really building this business to leave it to the next generation. We're not building it for us to, take a big chunk of change off the table and say good luck to you later down the road. We really have a different mindset, and I think that mindset is one that is well embraced with people that have long-term vision. Now, of course, that doesn't mean that we won't get into management arrangements where the doctor's goals are to build it and then to sell it to maybe a majority company, and we can help them with that. We'll prepare for that. We will actually negotiate on their behalf and allow a majority company to come in and buy both us out of our management agreement. Of course, we don't have equity, so we won't have any participation in that, and then get the best deal for the doctors, and then we can go on to the next project. So we really want to align our incentives with our surgeons and how they, what they're wanting to accomplish, what their goals are, and help them accomplish those goals. And so it's a really partnership model that does not limit what they can do or what they want to do. And we certainly have no authority to dictate because we don't have any ownership. So all we can do is make suggestions, but ultimately our physicians make 100% of the decisions for their own centers.
Yeah, and that's really nice too. So you have basically the operators, owners working with you to structure in a way where both sides are comfortable, and then you're moving towards the ultimate goal of wherever they want to go. Maybe they want to sell it someday, or maybe they want to keep a legacy. It's kind of up to them. You can help them manage it. It sounds like in multiple different ways. So
exactly. So it's just more of a, I would say, an alignment strategy where we're going to be able to provide the service that they're wanting to have provided. So we have more of an attitude of servitude. What is it you want to try to accomplish? We're going to serve you the best we can to help you accomplish that goal.
Excellent. And then how is the industry kind of adapting to what you're doing? Or is this like a big shift from what the rest of the industry is doing? Because I heard it sounds like there used to be like a fee model before, and then equity focus as well. Is there a shift occurring, or is it just is this like a new thing, structure?
We're really quite the outliers. Okay. Yeah. There are companies that are management companies strictly, managed. There are companies that just develop. There are companies that strictly consult. And there's a ton of the companies that are equity partners and have to have the whole enchilada. And so we're quite an outlier because we're offering to consult if consulting is needed. We're offering to manage, and we're offering to develop. And all of that can be done in one package, or it can all be split apart individually. So I think that we have more of, and we have more of a flexible program. I don't want to say a cafeteria plan because it's not like, what do you want to eat today? But it is a more strategic outlook of alignment with the physicians and, quite frankly, with with hospitals and hospital systems too, because, there's hospitals that are in joint ventures or want to develop or want to acquire existing centers. And a lot of the hospitals have never been in the ambulatory surgery center world. So therefore, they don't really understand the business as well as they do on how to operate a large acute care hospital. And so the expertise that we have with, I've been 40 years in the industry. My partner, Kim, has been an operator for 25 years. And so, we've got really veterans that have a lot of scars from, the good, the bad, and the ugly in the industry, and it's taught us a lot. And that's why we're able to be experts in our industry and really help people accomplish the goals that they have in mind.
Yeah, it sounds like they have a wealth of knowledge at their disposal and working with you. And so kind of getting more into systems and efficiency, like when you're working with your clients, are there what are the pain points in your business today?
Well, in our business or in our client's business?
Your business specifically. And it could be the clients too, because it could be going both ways.
Well, I'd say the pain points in our business is that it's always work to continue to bring on other clients. I mean, I'd say the biggest pain point is probably attracting those that you don't know. The networking aspect of the people I do know, that's relatively, I would say, pretty easy because I've got a robust network of people, and so does Kim, that we've worked with in the past that we have really good relationships with, and they support what we're doing, and they would actually recommend us to others. So what we're really trying to do, though, is the biggest pain point is reaching out to those that are new in the space, the doctors that are younger docs that want to have a facility, or the doctors that are now wanting to leave the hospital systems as employees and they want to do something on their own. They really need the help of a company that has the expertise to help them be able to accomplish that. So the biggest pain point is, how do you reach them? How do you find these people? And the old way of doing it, which was either number one, advertising, number two, going to conferences, and then number three, networking, those are still somewhat productive. The networking aspect is really productive. But what we like to do is, we like to have, instead of putting a bunch of money in marketing, in the big black hole of marketing. And marketing is one of those things that, who knows? You could end up, putting a couple $100,000 into marketing, and you may not get one lead. You may not even get a client at all. You can spend hundreds of $1,000s going to conferences, and you may not get a customer. You just don't really know if that conference is going to net the decision maker that can make the final decision to say, yeah, we'd like to partner with you. And so, although we will attend conferences and network in certain conferences, and although we certainly network, and we do have a marketing campaign that just started yesterday, and the marketing company we're working with is a performance-based marketing company. So just like us, certainly we paid them to create the content. So we had to pay, if you will, kind of like in our business, we kind of paid the management fee, but then we give a share of the actual gain to them when we have success. And quite frankly, we only launched it yesterday, so it's too early to tell if it's going to work or not, but we're willing to take that risk. But what we're not willing to do is to just dump money into a promise that, hey, we're going to be able to help you bring in more customers and more leads. We're not really willing to take that risk, and we're trying to be good stewards with our money. And therefore, so that's quite frankly our biggest challenge.
Trying to navigate that. Yeah, that makes sense. And then it sounds like you got somebody who's helping you with that, which is great. You just started launching that. And then what's working really well right now, and what's been harder than expected in your business?
Well, I think what's really working well is that when we share our model with anyone we share our model with, whether it's an industry colleague, whether it's a group of physicians, whether it's a health system or an individual hospital, everybody is embracing this model, and they really, really like it a lot. And so that's been a real positive. The challenge is, in this information era that we're living in, there's a lot of people inundated with a lot of information, and some of that information is true, some of that information is false. And the climate in our country and the culture, there's a great bit of cynicism, because we've all faced things. People have told us things that weren't true, and we've all gotten into business arrangements that turned out to be detrimental, and where we've lost money, or we lost time, or it was contentious. And so I think there's a little apprehension at times, because people go, well, I took a chance on somebody before and it didn't work out. And how do I know if these people are legit, or if they're going to be able to do it or not? And then I think that's why our performance model really kicks in, because there's not that same level of risk. They have the opportunity to go, well, if you don't perform, hey, we always say if we don't perform, then you can get out of the contract. We're not going to fight them tooth and nail if somebody's not happy. And, we haven't had that scenario where somebody's not happy, because, we truly pride ourselves in not over-promising and under-delivering. We want to be realistic about what the scenarios are. We take a very detailed analysis through due diligence of what the opportunities are, what type of impact we can have, and we're just honest with them about the impact. And we work really hard to try to accomplish the goals, but we never want anybody to go, man, I'm really sorry that I worked with that company. And that's really the biggest the biggest goal that we have is we just want to be known as people that do what they say they do and really work hard and are very understanding, patient, and long suffering to get the goals accomplished.
Absolutely. Well, thank you for your time today. I really appreciate it. Kind of diving into in your market and business development and how you can really help those ambulatory surgical centers and focus more on that performance-based model too, which seems to really be resonating with people, which is great. Where can our audience find you, like online?
Well, we have our website is the WoultonGroup.com, and I'll spell that because it's it's pronounced Walton, if you will, or some people say Woulton because the way it's spelled, but it's WoultonGroup. So that's WoultonGroup.com. We have a we also have a page on LinkedIn. So the Woulton Group on LinkedIn. And then of course they can reach me personally. I have a personal LinkedIn as well. And so does my partner, Kim Jennings. And so they can reach out to us. That would, of course, I prefer not to probably put my cell number on here.
No, that's fine. No cell number. So.
And of course, I'm happy to share my email, which is kennyspitler@.com. So if anybody has any inquiries, would like to talk to us further and reach out, that'd be great. And they can look for our campaign that is actually being launched on LinkedIn as yesterday. And we're going to be doing executive roundtables. So my partner and I can field questions, it's really, we'll talk a little bit about what we do, but it's really more about answering questions from interested parties and hearing about what challenges they need addressed. And so those are the ways that they can get in contact with us.
Excellent. Well, thank you, Kenny, for your time, and great to have you on the show.
Thank you so much, John. I greatly appreciate it. You have a good day.
You too. Thank you.
Thank you. Bye-bye.